Today, Group 3 will be talking about Clear Channel Communications, and our group members include Allison, Marcus, Manwander, and Elizabeth. Clear Channel Communications Clear Channel Communications is an American mass media company headquartered in San Antonio, Texas. It was founded in 1972 by Lori Mays and B.J. Red McCombs. The company specializes in radio broadcasting through division Clear Channel Media Entertainment and subsidiary Clear Channel Broadcasting. The company also specializes in outdoor advertising through subsidiary Clear Channel Outdoor Holdings. The company currently owns 854 AM and FM radio stations in the U.S., which makes it the nation's largest owner of such properties. It reaches about 110 million listeners every week. The company also leases through XM Satellite Radio and has expanded its online presence through iHeartRadio. Clear Channel Outdoor is an advertising side of the company. It operates over 500 digital billboards in 32 markets, which include many different countries like Switzerland, Poland, and Chile. The company has also had several television stations but has sold that sector off. Next, Ali will introduce the LBO and its participants.
On November 17, 2006, it was decided that Clear Channel Communications would become private by selling off the company to Bain Capital and Thomas H. Lee Partners. A little background information on each. Bain Capital Incorporated has been around since 1984 as an asset management and financial service company. Over time, the company has invested in or acquired hundreds of companies and oversees $70 billion in assets. In addition to Clear Channel Communications, some of the other well-known companies include Burger King, Sports Authority, Dunkin' Donuts, and the Weather Channel. They have a reputation for being aggressive and are getting what they want. The other fund participant is Thomas H. Lee Partners, or THL, which was established 10 years earlier in 1974. It is one of the oldest and largest firms focused on private equity and leveraged buyouts. In almost 40 years, they have raised around $20 billion in equity and invested over 100 companies, some of which include CTI Foods, First Bancorp, and local Park City Holdings Incorporated. Together, these two investors rose initial funding from a group of 6 banks led by Citigroup Incorporated. These include Citigroup, Deutsche Bank AG, Credit Suisse Group, Morgan Stanley, Royal Bank of Scotland Group, and Wachovia Corp.
Moving on to the rationale for this transaction. For Clear Channel Communications, the transaction was attractive because of the market's growing disinterest in radio stocks. Additionally, Clear Channel was interested in taking the company private because strategies to increase stock value, such as buybacks and dividends, were not having a desired impact on stock price. For the private equity buyers, prospects for local advertising and also the effectiveness of radio advertising were two main factors that made the deal appealing for Bain Capital and Thomas H. Lee.
A little bit about the transaction. Clear Channel agreed to a buyout in November 2006 for a total value of $26.7 billion by Bain Capital and THL. Together they agreed to pay $39.20 a share, almost $19 billion in equity, and secured $8 billion of debt from the group of banks led by Citigroup. Bain and THL ultimately won out against competing investors, which included Providence Equity Partners, Blackstone Group, and Colbert Kravis Roberts and Company, in one of the biggest takeovers up to that date. Trouble came about in early 2008 when the banks refused to provide the agreed-upon funds for Bain and THL to complete the takeover. Since the date of the agreement, loan prices had fallen and the banks were set to lose a couple billion. 2 separate lawsuits were filed, one in New York and the other in Texas, going after the banks for backing out on their agreement. On May 13, 2008, an agreement was made that would result in a total acquisition price of $25.8 billion and included higher interest rates on the company's debt. This was an 8% decrease from the original offer with a share price of $36 even. In addition to the modified price also came a deal that was very unique. A reverse merger would ultimately take place in what CFO.com calls a two-corporation LBO. More detail to be given on this later.
Approval from the Federal Communications Commission's board was required in order for the merger to take place. The Communications Commission is comprised of a 5-person board. 3 seats were held by Republicans and 2 by Democrats. The two Democrats had considerable trepidation about the proposed merger. Commissioner Michael Copps, a Democrat, went on record saying, "If I had the ability to launch an FCC inquiry by dissenting to this transaction, I would." He had concerns that a private equity firm was not the ideal owner of a large media outlet. He questions whether the profit-minded business tactics best ensured that broadcast licensees protect, serve, and sustain the public interest. Despite the opposition, the merger approval was successfully obtained on January 24, 2008. The LBO sponsors utilized a unique organizational structure to carry out the merger. This structure resulted in tax advantages for both new and old shareholders alike. The sponsors formed a new entity, CC Media Holdings Incorporated. This company was responsible for obtaining equity financing. CC Media Holdings then formed a subsidiary that was responsible for raising debt financing. Once the requisite capital had been raised, CC Media Holdings merged with Clear Channel. Clear Channel shareholders could elect to receive cash, shares, or a combination of both. Clear Channel shareholders that elected an equity exchange were entitled to a value up to 30% in CC Media Holdings. These exchanged shares had an estimated value of around $1.1 billion. No Clear Channel shareholder was allowed more than an 11% stake in the newly formed CC Media Holdings. The structure of the deal enabled old Clear Channel shareholders to qualify for exchange treatment with the IRS. Old Clear Channel shareholders were treated as founders of the newly formed CC Media Holdings and did not have to incur any taxable gains. This helped investors circumvent a potentially large tax bill. Clear Channel shareholders who elected to receive cash were liable for capital gains taxes. LBO sponsors agreed to purchase up to $3.94 billion in equities. They agreed to raise a total of $22.125 billion in debt financing, $18.525 billion of which was raised through senior secured credit loans. LBO sponsors secured a credit line of up to $1 billion in a receivables-backed credit line. A $2.6 billion secured bridge financing credit line was also obtained.
As was mentioned previously, both debt and equity financing for the buyout came from the 6 banks mentioned. The financing of the transaction became problematic when the banks tried to change the conditions of the agreement as credit markets began to shift. The banks were looking at potential losses of $2.7 billion due to the tumble in bank loan prices since the agreement was established. Because of the issues, lawsuits were filed. Bain Capital and Thomas H. Lee Partners filed complaints in New York State Court. Additionally, Clear Channel Communications and CC Media Holdings filed a $26 billion lawsuit in Texas. They requested damages and also an order to bar the banks from interfering with the transaction. The legal battles created a lot of uncertainty around the buyout, creating an extremely volatile stock price that dropped as low as $26.92 the day that the lawsuits were announced. The lawsuits against the banks were filed, and in the end, the banks, private equity buyers, and Clear Channel were able to compromise in cutting the share price to $36 per share. The transaction was finally completed in May of 2008 for a total cost of $26.7 billion.
Since the LBO, Clear Channel has had a close call in late 2009, early 2010 when their debt ratios climbed ever so close to the 9.5 times EBITDA limit. Luckily, it was only a scare because they were able to keep it under control and avoid bankruptcy, which seemed to be in their near future. One of the biggest achievements that has been the success of iHeartRadio division. iHeartRadio is an internet radio that started out by banding together over 800 of Clear Channel stations to one place for listeners to find almost any radio station their heart may have desired. Since its inception, it has continued to grow and become more successful with each passing year. It seems that after their scare a few years ago, Clear Channel has done well for itself. Compared to their low of $4.84 in 2009, they currently sit at $8.09 a share.